Yeah, I think you got to be thinking about the oil market in terms of how you envision a resolution to the conflict. And so if you think that the conflict is going to continue and that this fragile ceasefire is not going to hold, well, that's certainly a bullish indicator for oil prices. If you think that we're just in a phase where there's back channel negotiations going on and we're going to get some kind of resolution in the near term, then that would potentially be a bearish indicator for the market. And right now, you've just got this cognitive dissonance. Is the conflict going to be over, or is it going to extend for the foreseeable future? And either outcome is really potentially extremely bearish or extremely bullish for the price.
So what are the futures markets telling you they're up?
Yeah, well, it's a good question, Paul, because for anyone who's been following, there has been generally a pretty big disconnect between the futures market and the spot market here today. So if you have a tanker of oil and you're trying to physically get it delivered today, you're probably paying a premium relative to what the futures market price is. And effectively, the way to read it is that the folks who are active in the futures market maybe perhaps see some kind of easing, some kind of resolution to the conflict, and that things will start to normalize. If you look out through time, the price for contracts further out is lower than where the spot is today or where the near futures contracts are.
We're also seeing that Intercontinental Exchange has boosted the margins that traders have to post for its Brent crude and European diesel futures contracts since the start of the war. How does that play out in terms of the price action?
Yeah, it's a good question. I think probably there's a lot of folks who are active and thinking about energy markets that aren't normally there. We've seen a lot of interest flow into the space, and perhaps the exchanges are observing all of the increased volatility and perhaps new entrants and have modified their requirements for margin. But we haven't thought through deeply what's that sort of like technical factor may have on the market. But I think that, again, the real thing to be thinking about is the geopolitical risk premium. When we entered the start of this year, generally folks viewed the market as well supplied or even oversupplied. And if you get rid of the geopolitical risk premium and you get flows resuming through the Strait of Hormuz, then there's plenty of oil. If the strait remains closed and you have this very large risk premium in the market, then there's just simply not enough oil to make the market clear until the strait reopens. And so I think the two very sort of discrete outcomes. If you get the strait open, plenty of oil. Strait remains closed, not nearly enough.